something you said got my attention, which is when you're looking for places to hide. And so I hear you say that, and I'm curious if that means that you too are trying to find places not in data center alley or not in the center of the chip war that make more sense as an investor right now.
Yes.
Yeah. And rather than go to cash or sit in treasuries, you're looking for other places to hide that will still make money, but might not go up 40% in a week.
I think
I feel like
who doesn't want 40% in a week? There are things going on in the market where I'm a long-term bull, but we have more SpaceX later in the show. You know, we have Elon Musk saying that $1 trillion in revenue is possible in 2030, which is a 15-fold increase from 2027 estimates. There are things that feel like they're on fire right now. So what do you do? And real estate does feel like a place where you can hang out for a little bit. And I can go to the end of the show now if you want to right now, but I've picked up some REITs to do that. I've done Cousins Properties, which is like a Class A office REIT. I picked up some Americold a while back, which is a cold storage chain, where a lot of the analysts on Americold were saying like, oh, this thing is what is it? It's a commodity. Doing refrigerated warehouse space is a commodity. And there's another player in it, but I don't think it's something that's easy or anyone can do. I think there's some specialized knowledge that it takes to be able to run a cold storage chain.
Is refrigerated storage still as much of an issue when we're not worried about producing and keeping millions of live vaccines for this pandemic that everybody is being affected by at the same time?
Square footage, I don't know how that compares to the amount of frozen pizza that Americans eat on a daily basis.
Okay.
If we're just looking for space inside the freezer, the vaccines are very, very tiny.
Sure. I understand and appreciate the logic of it. I just haven't spent nearly as much time as you have thinking about the cold chain. A couple others I throw in the mix, like we talk about the data center boom that's happening. I own Digital Realty. I look at it every day and say, this looks like something I should trim because a REIT has no business being up the same level as like Apple for the year. But to me, it's a safer way to play the data center build out than owning the neo clouds, for example, or any of the other crap that people are getting excited about and throwing money at because it's involved in the build out process. Because like them and Equinix are pure play, you know, this is how you get access to the data center leasing side of it, building side of it, whatever. Also, Prologis is the largest landowner in the entire United States, maybe even around the globe. And they're parceling off parts of undeveloped tracts of land that are only good for building data centers in the middle of nowhere where neighborhoods are not going to be disturbed and pissed off that they see construction gear coming. So those are a couple that I've been increasing exposure to while trying to take some chips off the table and kind of get out of the way for these trees to start falling.
Prologis. You've been okay. I think pretty sure this is not a great thing to say on a podcast. I have owned it at one point. I'm pretty sure I still do. I should know this off the top of my head. I do have a real estate basket that involves, some office cold storage, and I believe Prologis is.
I only own 19 stocks, so it's very easy for me to tell you what I have. I cap it at 25. That's the most I think my human brain is capable of going deep on anything.
Yeah.
Once you get past about 30, like it just gets hard to keep track of all your kids.
I think that's a wiser way to do it. However, I still have some kids that are around from a previous relationship that I haven't.
Nick Cannon out here.
Yeah. Oh, thank you for the comparison. But other than that, I just spent earlier this week. I spent about 4 days in a hotel conference room, just absorbing information. So you might get to lead. I need a little forgiveness. My brain is still fried from that.
And I've been there. I know the course you're talking about.
Yeah.
You care to share what you're spending these days in the conference room for? Yeah,
I'm studying for the CFP, and so that test is coming up for me in about a month. And so anytime you have a big test like that, you get to that, oh shoot, I have 1 month before this, and I've been studying for it for 8. If you hear something in late July from me on the show, it means I passed it. If you hear nothing, it means keep listening to the show, like and subscribe on Apple Podcasts, and don't worry about anything I'm saying right now. But yeah, it's a little bit of a beast. As anyone who has taken the exam knows, it's a lot of rules that you have to learn that don't make sense in some ways. Some of them make a lot of sense, but I'll give you one that I think is interesting. Let's say I'm a financial advisor. Malcolm, you are the client. And I tell you up front, I can only sell you a proprietary product at our firm. We only do Ricky's House of Investments. And looking at your needs, you have about, let's say 25, 30 years to retirement. You have a long runway of growth. And with that, we have a growth mutual fund that looks into all of these wonderful growing companies, maybe even some data center REITs that you just sold. However, I have to let you know, the way I get paid on this is that there's a 4% load up front and then a 1% fee on this throughout the rest of your life. So you got to pay me 4% up front for this mutual fund. I am still a fiduciary in this scenario. Like, I can call myself a fiduciary.
Yeah, because you told me the facts.
Yeah.
Yeah.
Whoa.
Well, I mean, a true fiduciary doesn't have the conflict in the first place. I think that's where you're leading us to. True fiduciary does not actually have the conflict of interest in their back pocket to begin with.
This is the world, though, where you said true. There shouldn't be a lot of words where, okay, I'm a police officer or I'm a true police officer.
But that's a great comparison, because there is such a thing. There are the people who walk around in uniforms that say special police. Maybe this is a DC specific thing. I don't know, because there's a lot of law enforcement walking around DC, even pre-Trump. But there's special police. There's Capitol Police. There's Metro Police. There's all these different police officers that are or are not. They're in their jurisdiction. They may not be in their jurisdiction. I may not have to listen to you. I may not have to listen to you. You may have a gun. You may not have a gun. Like, there's all these different nuances. And I think that's the perfect description for what you're talking about. Because if I am the general public and I'm paying any attention to the personal financial advice space, I have no idea who the hell is credible, who I should listen to, who I should not listen to, who's trying to sell me some crap, who actually stands to get paid more by me investing in this thing than I stand to make by investing in this thing. Like, none of that is clear. And part of the reason for that is there's so many people fighting on Capitol Hill to keep from having to clean this up and make it clear, because those people make their money on the vagaries.
All right. We have a ton to talk about on the show today. That's not just intro banter. Malcolm has more thoughts on the SpaceX IPO. Hey, maybe his Instagram can go viral again. We'll try to pull that feed off after the break. I am seeing AI. You're seeing it impact companies like Meta in terms of their employment, but also State Farm. There's a wild story in the Wall Street Journal I want to talk about with Malcolm, and he wants to talk about the Young's day trading. So let's get into it. All right, the SpaceX IPO is the content gift that keeps on giving. I mentioned this a little bit earlier with the estimates on sales that CEO Musk is putting out. This stock had a higher market cap than Amazon and Microsoft in its third trading day. I'm optimistic about the space economy. I've talked about that. I haven't been a bull on SpaceX. I want to make that clear. I've done some journalistic work. What?
Are you sure?
I said that I want them to succeed, but that is a different, I can root for, this is a bad comparison. I can root for a team to win, but that doesn't mean I think they're going to win. Those are two separate statements, Malcolm.
So I can tell you this now because I survived it in the moment. Yeah. I was secretly rooting for the Spurs to win while also in New York City, surrounded by Knicks fans watching the game. So I know exactly what you mean. I can root for you, but it doesn't mean that I have to be like on your side eternally.
You're in New York all the time. I'm surprised you weren't getting caught up in the Knicks fever.
Nah, I just really wanted the series to go 7 games. Okay. Like, I didn't want it to be over. It was a really good matchup, and I felt like the Spurs just gave up. And so, anyway, not to derail this into
Oh, I'm
NBA.
derailed for a moment. As a Cincinnati sports fan, listening to New York sports fans talk about what a victim they've been for decades was something that drove me to root for the Spurs. I don't care if Wemby's a dirty player. I don't care if this is a team of destiny. The whole we need this championship. We haven't had one since the 70s. You are the center of culture. You are the center of finance. You are the center of sports in some ways too. Stop complaining. And so because of that, that led me to root for the Spurs.
I understand the logic of a person who was born 50 or fewer years ago who says, I live in a city where our sports teams used to be great, but I haven't had a chance to see them win in my lifetime. The Yankees are probably the best you got because they were really great in the 90s, but everywhere else, maybe the New York Rangers, but everywhere, you know what I mean? Like basketball wise, you haven't really had a whole lot. You've had a bunch of heartbreaks. That's, so I get it.
Okay. Take their side. Let's get back to
I only
SpaceX.
root for winners, though, so I don't know anything about this.
You only root for winners.
I have seen the Cowboys win in my lifetime.
Mm-hmm.
I have watched the Lakers win a bunch of times in my lifetime. So I don't know. I don't subscribe to rooting for losers.
Do you want to talk about SpaceX? Talking about rooting for winners, because this thing is winning.
Are we rooting for winners, or are we rooting for an inevitable loser?
Higher market cap than Amazon and Microsoft. And by the way, something I said too, I talked about forced buying after this IPO because the index funds having to pick it up. I think there are, explanations of retail traders are really excited. And I think it's like half the stock was traded hands over one trading day. I think there may be an underrated element of index funds knowing they have to pick up this stock before it gets included into the NASDAQ 100, whenever that may be in the next, 2 weeks to a month. But
it was, listen, this was some of the best engineering, some of the best financial engineering we have ever seen in our lifetimes. All of the elements of how this thing functioned forced it so that heads I win, tails I win. And we're seeing if you watch the sell-off that just happened Thursday, I think it was, the stock tried to sell off and the market wouldn't let it for one reason or another. And I bet you part of the reason is what you're talking about. Like it got all the way down to like 170 something and then shot all the way back up past 190 because every 30 minutes or so, there kept being this force underneath it that was sending the stock back up.
The other part of this that we have not talked about is revisiting the SPVs, the special purpose vehicles. This was a question we had for Yuri Kojamirian, who is he has the NASA ETF, which, by the way, now has $2.4 billion in assets under management. When he was on the show, I think it was about 20 million or something.
So we're
like
responsible for about $2 billion worth of growth, is what you're telling me.
If you would like to hype your ETF, we are open for advertisements. Malcolm will do it for you. And he will make sure that all of our listeners, which include billionaires, there are many billionaires who listen to this show, they will hype it up. And that's why our ad space is incredibly valuable. It's worth a lot of money. Anyway.
Are these all people who have been made billionaires since SpaceX went IPO?
Millionaires or billionaires?
Are the people who listen, are the billionaires who listen to us, all the people who they're hate listening because they just became billionaires from the SpaceX IPO?
At no point have I hated SpaceX. I said
no, you have not openly hated SpaceX. That is true. But as a person who looks at a company, we keep finding it's like the gravitational pull of this company is so freaking strong. Like I think I texted you right when I saw SpaceX is now more valuable than Microsoft, and then it became more valuable than Amazon. I think it became like number 4 on the list of all the publicly tradeds. And for context, like Elon Musk is saying, we're going to get to $1 trillion of revenue in 4 years, in 3.5 years. Amazon, I think, does the most revenue of any publicly traded at like $700 billion or $720 billion or something like that. And it's taken them 30 years basically to get to a point where they're generating that kind of revenue. And this dude is saying we're going to go from, I think, 35 billion now that they've got the Anthropic contract
to $1
trillion. Like math doesn't work that way. But
unless
okay.
You really need space-based data centers to work. Last thing I want us to talk about on this is the special purpose vehicles. This is the other issue. The SPVs, which are, there are these funds that have SPVs worth of SpaceX stock. It was something we asked a fund manager about. You can check out that episode for the response. But this is where things get messy because, as quoted in TechCrunch, the problem is that you have a communication train with each person only knowing what's going on in the layer above them. So you have these vehicles that have SpaceX stock, but it's hard to tell if you actually have SpaceX stock. And what happens ultimately when those start unwinding is an open question mark.
Yeah, and I get these emails from these strangers that say, like, our fund, the Ricky Fund, has allocation to SpaceX, Anthropic, OpenAI. We can get your client's allocation. Just click here. And essentially what they are is a special purpose vehicle that has invested in some larger fund that emailed them and said, we can get you allocation to these companies. And maybe somewhere around there is actually the person or the fund that had the allocation to begin with. But you got to go 3 or 4 layers deep, like you said. And the only thing that's guaranteed to actually happen as a result of this is not that you're guaranteed allocation to these companies. It's you're guaranteed to pay a ton of layered fees for the people promising to bring you into the fold. But that's the thing with private investments, right? It's always, how much am I paying in fees should be one of the very first things that you're paying attention to. And then how many layers are there between me and the thing I'm actually investing in? And a lot of times, I bet you people would be surprised.
This episode is sponsored by Capital Area Planning Group. Capital Area Planning Group is a fiduciary wealth management firm that specializes in helping high net worth individuals and families navigate the complexities that come along with managing concentrated stock options, multiple income streams, and an ever-changing tax code. While our team of certified financial planners are well-versed in all things personal finance, our areas of expertise include equity compensation, estate planning, and multi-year tax planning. At Capital Area Planning Group, we believe in pricing transparency. That's why our fees are posted on our website, right alongside the various services we perform on behalf of our clients throughout the year. If you're tired of receiving the same cookie-cutter advice from your financial advisor, then don't wait. Reach out to us today at capgllc.com to experience a better approach to wealth management. Again, that web address is www.capgllc.com.
I want to talk about this AI story. And normally when we talk about AI and employment, it's been from the perspective of big tech. These big tech companies that are making the AI future, simultaneously the ones laying people off. It's been a big story at Meta. It's been a big story at Oracle. We've talked about it. Now, there's an absolutely insane story, in my view, about State Farm coming out of the Wall Street Journal, where they're essentially ripping up the contracts for roughly 19,000 independent contractors, and they did so at this big Las Vegas convention. So you can imagine the State Farm Las Vegas convention where you walk in, you get to get a picture with Jake from State Farm. He's on all the commercials. I think he what's it like working with Steph Curry? Is he nice? Is he nice in person? Then you go from that, and then you get some convention center food, and then you're treated to an evening with a concert by Pink. She's doing her aerial acrobatics, and you can't believe that she's able to sing while hanging upside down like that. And then they have the sing along with Jimmy Fallon, which for State Farm, they're probably doing Happy by Pharrell Williams. So you're clapping and singing Happy by Pharrell Williams. Then the CEO comes on stage and says, State Farm needs to change. You all need to use AI. We're ripping up your contracts. If you don't get on board, we're lowering your commissions. And also, because you're an independent contractor, bye-bye to health insurance.
You lost me at convention center food. First,
I lost you at convention center.
Yeah,
I was trying to give you a setup. I was trying to give you a neat setup to respond.
I appreciate you so eloquently painting the picture for me and really filling it in with colors. But as soon as I heard you come into this room with convention center food, I was like, I'm going home.
How do you think they're feeding people at the State Farm convention?
That's fine. Listen, I don't go to very many conferences I get invited to at this point because convention center food. Anyway, it's called
Next Gen Good Neighbor, which is framed as a human plus digital approach that pairs AI tools with its existing agent network. And there are two things here that I think are kind of interesting. Number one is that this selling car insurance is something that there could be some AI in there. I'm actually like, the process of buying car insurance is one where there's a few definite paths you go down in terms of questions. And it's pretty standard in terms of what your coverage actually is.
Mm-hmm.
And you also have a lot of these jobs like this, where if you're an agent for State Farm, if you're an owner of the office, maybe you're making great money. But if you're an agent, you may not be raking it in. And you have a lot of these jobs where you now have companies, not just at the top big tech level, openly saying, we are cutting the amount of money you're making, and you better get on board with AI now.
Yeah, I mean, first of all, good riddance. Like, the insurance industry has been ripe for disruption for decades. It sucks. Everybody knows it sucks. Even 40% of the people who work in insurance will admit that it sucks. And so the way that people have to think about buying insurance needs to be flipped on its head. It's similar to the car buying process, and the fact that like all these dealers are complaining that now, Volkswagen, I think, was the latest one that decided to go direct to consumer following the Tesla model, because they all want their golden share at their dealerships, and for you to have to come in and sit and sweat and, waste all day with terrible coffee. Yeah. Like, these models of legacy ways that consumers have gotten access to things in the past are the most ripe for destruction. Mortgages probably will get disrupted too by the home buying process as a whole, but mortgages specifically, because people hate having to shop for it. Insurance makes sense. Car buying makes, like, anything people hate having to shop for is perfectly ripe for disruption. And I don't think it should be a surprise to anybody that State Farm or any other insurer is taking this stance, because there's going to be all these startups that come along trying to find a way to place people with the perfect right insurance using AI, and that's going to push them out of the way anyway.
I agree. And that's where I was going, which is, I am a, State Farm car insurance. This story made me look, because then I started looking at the like State Farm Reddit threads where people are in there talking about, they're complaining that executives get paid too much. And, once you just replace this with AI, that means you lose the human connection of working with an agent. And that's something that people really value. And I was thinking about it. I'm
40 years ago.
I'm a safe driver. And my human connection was an agent explaining to me, wow, despite being a safe driver and a relatively low mileage driver, because I work from home for the most part, that they're still jacking up my insurance rates.
Yeah.
And they're sorry about that. And they really empathize with me, because it's just crazy and it's going across the industry. I'm like, I don't want you as a therapist. I want low car insurance. And then this story made me revisit it, and I can't do it because I got the 6-month contract. If I went to a cheaper insurance provider, Lemonade, I'd be paying $100 less a month. The
solution they have is, let us put this monitor in your car to see just how safe a driver you are.
And it still didn't lower it. And I'm a safe driver.
Now that's surprising. So you made me go through the trouble of passing your little test, and you still didn't lower my rate. That would
not that much.
Yeah.
I mean, my car did, we have 2 cars in the household. I think my car did like 10,000 miles last year.
Mm-hmm.
Nothing crazy. But you didn't give me, I do not feel properly rewarded. So anyway, all of this is to say, you're seeing this mass destruction, mass disruption. And the complaint is, this does wreck a lot of people's careers. I don't think they'll have a lot of sympathy on the consumer side, because on the consumer side, you're saying my car insurance rate is up. I think it's like 40% since 2021.
Mm-hmm.
And I know auto parts are more expensive, but it's not like when supply chains got undisrupted, you lowered anything.
Mm-hmm. Mm-hmm.
So you're seeing some sympathies wear thin, I would say.
If we don't have any sympathy for the software engineering manager who's getting let go from Meta because they've decided that they don't need 10,000 people that they currently have employed because their jobs are so duplicative, right? We see those headlines and people say, oh, boo-hoo. Then I feel like the same applies to the insurance salesperson who gets displaced by AI, right?
I'm saying this incorrectly. I feel bad for what I was getting to is I feel bad for this displacement. And this isn't good when you're seeing a lot of these middle-class jobs evaporate. Simultaneously, I don't want to spend a bunch of money on car insurance. This is cognitive dissonance.
As a consumer,
I hold 2 opposing beliefs in my brain at the same time. It's really hard to do.
As a consumer, I am glad to hear insurance companies finding religion around reducing cost because the people are speaking.
Yes. And then on the Meta side, since you mentioned it, people are unhappy there as well. When you said, do I have sympathy for their software engineer? I have sympathy for the person during a company presentation that exploded during the presentation and told basically the executives on the call that they needed to write to a certain exec and tell him that he is a POS. And this is from, it was Wired. And what's happening at Meta is, when people get laid off, it's not like you get a raise and you get more work. And that seems to be happening at Meta right now. And then you have all of these software engineers that are getting pulled from projects where they were finding challenge. I don't know if meaning is the right word, but challenge and work they enjoyed to basically putting together puzzles for the AI to solve. And there was one quote saying, it's literally the gulag. You have zero purpose in life. All of a sudden, you barely interact with anyone. You just have these tasks every week. And there's now even a company-wide petition. More than 1,600 employees have signed a petition demanding Meta to stop a recently launched initiative to monitor U.S. employees' clicks and keystrokes that generate AI training data. What do you think all of the clicks and keystrokes are going to generate at Meta for their AI training data?
So this is what I think creates the undoing of a company like Facebook. Okay. So if you just think about the way that the company was initially founded and what has happened with it and to it since then, as long as they're rewarding shareholders, people have been willing to turn a blind eye to a lot. And I mean, a lot. Like, this is a dastardly company.
Yeah.
However, the one thing that you can't replace is the workers on the inside. And the workers on the inside, the ones that I know at least, let me not paint with too broad a brush and have people writing angry emails at me. But the folks I know personally who have or currently work at Meta, the very first thing they'll tell you when you talk about your issues with the company is how well they're compensated and how well the stock is doing. And as soon as that gets taken out of the equation, well, now I'm looking at myself in the mirror and going, what am I doing this for? I'm not making I'm not making a positive difference in the world. I'm not making the money that I used to make, or at least by comparison, I could go do this job elsewhere and make the same money. My relatives already don't talk to me because they're mad at me about some political stance they have against the company that I work for. Like, there's all these reasons not to want to do the job. But the thing that keeps you on the hook is, look, my stock just went up 30% this year. Why wouldn't I want to look? It's the best place in the world to be an engineer. Like, the projects that I work on are really stretch projects. Like, I actually learn how to do things that are going to be super valuable to me. Well, now if all I'm really being used to do is train a piece of technology that's going to eventually be the exact same technology that hands me my walking papers. Like, the fact that my skip manager is a piece of software is absurd, but like, that's the reality that I now see for myself. Why am I here?
Yeah, I think
that's what tends to bring down a company like this. It's the culture, the erosion of the culture that's going to be their undoing, not anything they've done to society and any of the other stuff.
When I was taking finance courses in college, I got sick of how much they talked about company culture and how important it was. Mm-hmm. I thought it was BS. I thought it was, once you get to a big enough company, things are homogenous. It's kind of all the same. And as I've gotten out of it, my cynicism for that has gone down for that perspective. No, company culture is really important. Who your CEO is really important at a big or a small company. And if people are really unhappy and they're telling you how unhappy they are and they're signing petitions, I think it is ultimately, I don't feel valued is what makes people feel really, really rotten. And even if you're working on something that addicts kids to social media to make them spend, 2 more minutes a day looking at Instagram, and I'm working on that project, but at least I feel valued. I feel like my contributions are noticed and I feel some autonomy in my work. Once you remove that, the question now is like, do you have anywhere else to go? If you're a big tech worker, it's pretty hard to find another job. There's a bunch of people who just got laid off you're competing with. But, and you can't quiet quit because they're cutting 10% of people a year. So you're just there spinning your wheels and miserable. Anyway,
well, no, you'll get some really talented people that are going to land at smaller startups that they wouldn't have considered in the past. So, underneath the surface, there's, I don't know how many billions of dollars being poured into AI startups right now. This is a completely different piece of the equation, but VC funds have been having to raise funds faster than they've ever had to do in the past because of the size of the checks they're having to write to get into a lot of these AI startups. Forget, OpenAI and Anthropic for a second, but all of the ones underneath them. Normally, a VC fund takes 3 to 4 years to deploy all of the cash that it's taken in from its investors in a particular vintage of a fund.
Yeah.
I've been reporting that within 6 to 9 months, all of that money's out the door and they're back talking to their LPs, looking to raise more money all over again, because not that there's that many projects that have come up that didn't exist yesterday, but the check size that they're having to write to get into these things because of the SpaceXs and the Anthropics and the OpenAIs, that's what's driving this. And so anyway, I say that to say there will be some really talented people that get compensated similarly to what they're able to get at a Meta. Or whoever else that didn't consider that opportunity 2-3 years ago.
So this is the bow I want to put on this story. I knew I owned it, which is Meta stock. I picked it up, I think, like 2023 when the thing basically crashed. Oswath Damodaran comes out and says, there's no way this valuation makes sense. Thank you, Professor Damodaran. Picked up some shares, did well. And then now it's like, okay, well, now you have a culture rot. And that to me is more important than losing 100 million daily active subscribers that may daily active users, that may or may not have been caused by like Russia and the Ukraine war. This is one where it's like people are not happy and they're not putting in good work. And that's not good for the next 5 to 10 years.
And at the same time, you have the government of whatever country in the EU coming after you saying, we don't want kids on your platform, deactivate them tomorrow.
There you go. So a lot there. Story I know you're passionate about. This one's from Bloomberg. Gen Z traders go broke in pursuit of a new American dream. Trading, very appealing to Gen Z because there is a feeling, and I think it comes from this feeling of the economy is not working for me. The stock market feels unsafe. And also, if I get a 10% return on what I'm making over the next 30 to 50 years, I'm still going to be broke. I'm still going to not be able to afford a home or be able to take vacations or be rich, however you define that. And so why wouldn't I just gamble? Because either way, I'm going to be broke. In one way, I'm broke with some money, or in another, maybe I hit it big on these options and trading.
So what's interesting about this to me is I started really thinking about this, and I can actually empathize with the brain of a 20, 22, 24-year-old who is looking at just quite simply index funds versus anything else. And the way that I mean that is when I was in college, the thing that attracted me more to stocks than anything else was the thing my parents and grandparents had taught me was put your money in the bank, get a decent savings rate on it, 2, 3, 4% if you're lucky. And the compounding of that 2, 3, 4% will be so great that you'll be so glad 50 years from now that you started the process of saving. And then I took, I think, Finance 1, if I remember right, and learned how to use a financial calculator and learned about the time value of money and just the future value of my money earning 3% a year for 50 years still only earned me like $14. And so I was like, well, this is stupid. Why would I own this? Like, what? So, okay, now I know what the stock market does. I know that generally I'm going to earn 9-10% in the stock market on an annualized basis. Why wouldn't I go get that return? Because it's 3 times the amount I could get just putting this money in a regular bank account. And so if I work backwards, that same logic applies, just magnified for a person who's now 20 years old, sitting in a college classroom looking and saying, my mom and dad have told me that I should buy index funds. Thank you so much, not Charlie Mungers. Thank you so much, Jack Bogle, for teaching us all about indexing. I'll just go buy Vanguard Total Stock Market. I'll get my 10%. Life will be great. And now that kid is looking and going, well, why would I want to do that? Inflation is creeping back up to 4%. That money doesn't really earn me anything. I'm not even going to consider putting it in a savings account, but I can buy SpaceX and my money can go to the moon, or I can buy whatever other momentum stock, Broadcom or something at the moment. And that's how I'm going to magnify what my money can do and the compounding effect of this. So I'll just become a trader. That's all I got to do. And so I can actually empathize with it. I think it's foolish just because of the increased risk that comes into trying to perfectly time the market as a person who knows almost nothing about the markets. That said, in this particular market cycle where everything seems to be going up and to the right every single day, I guess it does make sense to participate, get while the getting is good.
Well, why would you want 10% a year when, SpaceX can do 10% in a day?
That's what I'm saying. Like
that, why wouldn't you just, I get it. I get the appeal. You're like, I'm feeling broke. This money machine is printing free money. It's incredibly difficult. The more active you get with it, the statistics are bad, even with zero cost trading. Because you're going up against Susquehanna and, all of these market makers that have algorithms that move a little quicker than the human brain. But I mean, I completely understand it. I don't think it's foolish. I think it's, I understand why people do it. The longer you do it, the more foolish it becomes. How about that? But I also think that it's something what we've talked about on the show. If you feel this itch to do some degenerate stuff, keep it, separate your money. I know it's mental accounting, whatever, but if you need a little pot to scratch that itch, have that and do the best you can to separate it from your actual retirement money.
Well, you don't have a separate pot at 22, right? It's all one pot. I either need it this month or I need it 3 months from now.
If it's a few $100, you can do it with a few $100. You have a few $100 in your mid-20s. No?
Okay. No. Are you so far removed from 7-8 years ago of your life that, dude, at 22 years old, I need every dollar in that checking account. Okay. There is no separating things into two separate pots and all this, wisdom of Warren Buffett. It's what?
Do you know how many of those 22-year-olds have DraftKings accounts?
Okay. And how quickly are they making transfers between the DraftKings account and their checking account?
Probably
because they just realized they have more month than they have money.
Yeah, fair enough. Anyway, anything else on this Gen Z wants to trade stock story? I think a lot of it is stuff we've talked about on the show before.
But I think
I empathize with it. I understand why it's going on. It's a bull market. People are making money.
I think, unfortunately, what brings this whole thing back to reality is a cold, hard crash. Like, I remember how many people I was meeting in 2006, 7, 8 that told me they were day traders as their job. Like I literally had somebody I used to work with at CarMax when I was in college who quit his job because he became a day trader and he had taken some online course that was going to teach him. And people walked around at Starbucks or whatever, where you met them out socially and you said, hey, what do you do? I'm a day trader.
Yeah.
We've gotten back to that place, which tells me look out below.
And that's why we were talking about real estate at the top of the show. Let me walk through this a little bit. I'm looking at REITs. The one I was looking at earlier this week that I sent to Malcolm, I'm working on the thesis. I'm not there yet. So if you have thoughts or you want to say something to Malcolm about his pessimism towards SpaceX's future opportunities of making $1 trillion, our email is thistimepod@gmail.com. The one I was looking at is Hudson Pacific Properties. And it is a REIT that has been taken to the woodshed. Cutting a dividend will do that, and having a lower occupancy rate will also do that. But it's a REIT with a lot of California real estate, including Silicon Valley office space, and they also have some production studios in Los Angeles. Price has been beaten down. It's at 0.3 times book right now. A couple of years ago, the company canceled its dividend. But are things already improving for this company? And they're starting to see FFO increase. You're seeing some tailwinds. You mentioned the startups, the AI startups in the Bay Area, where people are going. They want to work in person. There's a sort of, return to the Bay Area for in-person work that I think is ongoing right now. There's also a lot of production credits in California that's leading more productions to slowly move back to that area. Now, in this case, one of the studios they have been promoting, they do micro dramas there, which is a soap opera in a 1 to 2 minute increment that you can scroll and then watch 100 of. I don't know if we're trying. Here's my problem with this. I don't know if we're retrying Quibi or if this is just a cultural thing that's extremely popular and I don't understand it because I'm ignorant. So either of those could be true on that. And also, studio space you can change up a little bit. But my point on this is this thing has already gotten beaten down. They're improving their FFO per share, which is like the earnings rate for a REIT. And so if things are slowly getting better, if you can find a company that's starting to uptick back to profitability a little bit, and they've already shown the steps that that's happening within their financials, not just a nice presentation from the CEO that talks about their North Star plan, North Star initiative to win customers back. Is that the time you pull the trigger and buy, which is, this is a speculative, greasy value bet, but maybe in 3 to 5 years, there's going to still be more people working in the Bay Area than not. Now, what's held me back from this is they've been buying up properties that have like a 40 to 50% occupancy, and they're saying our magic sauce can bring more people in the door. I don't know if that's true.
What's the yield on this REIT?
It's not paying a dividend. I told you.
Right. No. I'm sorry. Let me go back. I didn't expect this show to be a primer on REITs, but I think that's where we find ourselves.
Sure.
Rhetorically, what is the yield on this REIT that I'm proposing to introduce into my portfolio? Very first question you should ask. For something like this that you're describing, 40 to 50% occupancy rate on some of the properties they're taking up, it's a little more risky than other properties probably already in their portfolio. Definitely more risky than other properties and other portfolios of other more established REITs that I could invest in. So the yield on it should be substantial, right? I should be talking about a 6, 7, 8% yield, and I'm talking about a 0% yield because they cut it, right? I understand that part. But where I'm going with this is the thing that I want to ask the question on as a potential investor in a REIT is, how do these people receive their rents? Who are the tenants in these properties that are paying them rent? And do I have strong conviction, medium conviction, or zero conviction in the tenants of those REITs? That's how I'm determining what I want to introduce into my portfolio. So if I'm thinking about creatives, for example, nothing against the motion picture universe, nothing against the performing arts universe, but I know how up and down those businesses tend to be, right? There's only one Hamilton for every 100. I don't want to disparage anybody's play, so I'll just say non-Hamiltons, right?
Sure.
So if I'm proposing to own something like this, I want the dividend that I'm getting paid on the other side to justify taking the risk, because REITs typically are not supposed to be something that you own because you're expecting a tremendous amount of appreciation on the other side. You think about them like utilities, for example. Pre-ChatGPT, utility companies, energy companies traded very boring, and you own them because the dividend was substantial and also it was predictable, not because something like a Dominion Energy, for example, was supposed to go up 25% in a year because we realized how power constrained we were. So you really want to focus on the income component of it first, not so much the growth or the appreciation of the stock price. And that needs to be matched by a dividend on the other side that tells you the risk you're taking is commensurate with the payout.
So a couple of things. One, the studio business is about 1/10-ish of the office business. So it gets lumped in as like a studio REIT. It's a significantly smaller part of the business. The reason it's appealing to me is because it seems like the story has been beaten down a lot. The reason it's not so appealing to me is management is basically like, what if we get back to 90% occupancy?
Yeah.
And there's a lot of things that have to go right for that to happen. And because I'm not a real estate expert, my brain goes, play the hits. Don't get too cute with it.
Well, that's kind of my point. Like, I don't want to be a part of your what if story.
Yeah.
I don't own REITs for that purpose. Like you said, I'm not hoping that it's going to be a rocket ship to the moon. I'm here because I want boring and predictable.
Yeah. Has someone hurt you in the past? I don't want to be a part of your what if story. Sounds like you're breaking up with me, by the way.
No, I'm paying attention to what's happened the last 4 years and how the world has been set on fire by ChatGPT.
Yeah.
And I'm looking and saying, we had a good run, guys. Let's
So
shake hands and
are you looking at real estate then?
yeah. So I own REITs.
Yeah, we talked about it at the beginning of the show.
I own REITs personally. Very few. Like Digital Realty has been the largest REIT holding of mine to this point. However, in our growth and income portfolio that some of our more income-oriented clients are in, we've got REITs up and down the spectrum, and I've been adding to my own positions based on that because I typically don't want the income. Like you talk about a beat down story. I'm going to throw a little bit of a curveball here, but
sure.
Talk about a beat down story. Accenture is down 50% year to date, basically. It might be more than 50% now with the sell-off they just had, Thursday, I think, of last week.
Yeah,
but
50%.
Accenture is a company that pays about a 4% dividend yield, and their claim to fame is IT consulting, basically. And the market is making the bet that no one wants IT consulting from here on out, or at least they want 50% less IT consulting than they used to. But Accenture is a company that gets like $100 million engagements from their clients all around the globe to come in and help them understand how to build their strategy and execute it. And you think about a world of AI where people are very ignorant to how AI can impact and improve their business. Think about State Farm, for example, like you just finished talking about. Does State Farm have the capacity to hire the number of strategists and engineers internally to help them understand how to deploy AI throughout the entire tech stack within the company? Or do they have money to go hire Accenture to teach them how to deploy AI and which agents to get rid of and which ones to keep and which tools to build internally and which ones to rent? Like, that's really what they're proposing to do in this new age of AI. If you look at what IBM's been able to do building out their AI consulting book of business just in the last 2 years, that is essentially what Accenture would be able to do as well with different clients. And because they gave less than stellar guidance at their last earnings, the market just completely turned on it and said, "No, we don't buy the story anymore." I think there might be an opportunity there. So
it's back to its lowest level since 2017. All gains from 9 years have been wiped out.
That's nuts.
Yeah.
Like, that's betting that they will not participate in the future at all, basically. Like that, you know what I'm saying? Like, that just doesn't make any sense. They fall into the same category. I mentioned IBM. They fall into the same category too as like a ServiceNow that we're looking at and saying these guys will not participate in the future at all. And that just doesn't seem logical. And so anyway, I think that Accenture now fits into a bucket of beaten down, yes, but if you're an income investor, they're going to pay you a 4% dividend yield to wait for them to turn it around and really do a better job of telling the story. I think their CEO didn't do a great job of telling their story, and that's also what they're being punished for.
So anyway, that's a good place to end it. We ended in a little bit more of a finding opportunities space versus just like, it's been a good 4 years. We'll see you on the other side. Maybe we'll do a movie podcast until everything crashes. Anyway, let's end it there. You can find me. You know what I'm going to plug? If you've listened this far, you can find me on social media. I'm on Letterboxd. Speaking of movies, at Rick So Slick on Letterboxd. If you're listening to the show and you like movies, it's the movie social media platform. So you can just see people's movie reviews. It's really nice. It's a much more positive versus some of the social media platforms we've described where there's vitriol. And there's people who get upset on there when they don't like a movie. However, it's a very positive place. It's a place I enjoy brain rotting, is reading people's movie reviews. So Letterboxd, I will follow you back if you listen to the show and you review movies. How about that? You can find Malcolm on normal social media platforms at Malcolm on Money. And then if you want to write us, it's thistimepod@gmail.com. Thanks, and we'll see you next week.
Information shared in this recording and by its guests represent the views and opinions of the guests and does not represent the views or opinions of the host. This content has been made available for informational and educational purposes only. This content is not, nor is it intended to be a substitute for professional financial advice. It is always recommended that you seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your personal financial situation.